All right, so I think we'll get started. So thanks again so much for joining. We'll get started with some quick introductions and then get things kicked off. So I'm Jason DeMont with Foundation Capital. I work with our early stage network here. That includes both founders and the investors who focus on investing in companies at the earliest stages. And I've asked 3 investors that we work closely with to join me, and we're going to discuss go-to-market for early stage enterprise startups during the session. So the way we're going to do that is through a couple case studies, and I'll talk about that in just a moment. For now, I'll just have our speakers do a quick round robin and introduce themselves. Ariane, I'll start with you. So if you want to just do name, fund, size of your fund, average check size, and then any particular focus for your investments.
Awesome. Thanks, Jason. Hi, everyone. Ariana Thacker here, founding partner at Conscience, a $10 million fund focused on the intersection of consumer and science. And I do pre-seed and seed stage investments, typically $100,000 to $250,000 check sizes into that category, and excited to be here.
Shruti?
Hi, everyone. I'm Shruti Gandhi. I run Array Ventures, an enterprise deep tech fund. We lead first rounds with about $750K to $1 million, and round sizes are generally anywhere from $1 million to $2 million. You can check out our portfolio on our website, array.vc, but excited to be here and talk more about the go-to-market, especially on the cheap at this stage.
And I'm Pete Soto. I'm the founder of the Data Community Fund. We're a $10 million micro fund. We invest at the earliest stages of engineering-led, data-oriented companies, so companies that have differentiation across machine learning, data science, deep learning, data infrastructure, et cetera. I'm a former engineer, so I love to talk to other engineers. And our average check size is between 200 and 300K.
Awesome. All right, so hope everyone knows we're going to be discussing go-to-market strategies and tactics, again, for enterprise companies at the earliest stages. And so the way we're going to do that is actually through some case studies. Arun, you want to join us and get your screen shared? Cool, perfect, thank you. And while I do that, I'll give just a bit more background. So rather than discuss go-to-market in general terms, what I've done is invited Arun and then Mary as well, who's in the audience and will join us in a bit, to talk about their companies, their founders. And so they're going to give us a 1-minute pitch about the business, their target buyer, pricing, and other go-to-market info. And then what we'll do is we'll just have our speakers provide advice and frameworks that will apply to their business, the founders, and then hopefully those in the audience as well. Arun, how we looking on the, I'm not seeing your screen shared yet.
Okay, should I get into it now?
Yeah, please, yeah. If you want to share your screen. And then we'll do the start with a pitch about the business, hopefully around 1 minute, and then talk a little bit about go-to-market in general, and then we'll get started. So Arun, I'll let you go for it.
Cool. Can you see my screen, by the way? I just want to make sure.
Yep, all good.
All right, great. Hi, everyone. My name is Arun Lal, co-founder and CEO of Contique. And at Contique, we're reimagining the B2B selling and buying experience. So our pitch is pretty simple. We believe the B2B buying and selling process is broken. B2B buyers in this digital first world now are demanding personalized information discovery in one place and easier consensus creation among the buyers. I mean, generally there are 11 buyer stakeholders involved in a B2B purchase decision now. And then what the sellers are demanding are more insight, data-driven insights about buyer intent. And the new role of the seller is to be a trusted advisor. And in that role, how they can collaborate well with the buying committee to deliver shorter and faster sales outcomes. So that's what Contique delivers. We have the technology that enables a unified digital experience for buyers to get the right information they need to make a purchase decision. It's also a collaboration platform where buyers and sellers can collaborate to get to buying decisions faster. And this is Contig also presents a single pane of glass for buyer and seller interactions, and that enables the buyers to get to faster consensus among the buying process, and for sellers to get the right insights to guide the buyer. And as a result of that, sellers see shorter sales cycles, higher conversion and win rates, and larger deal sizes. Our Contig's overall vision is to be a B2B marketplace, a two-sided marketplace, which serves the sellers as well as buyers. And we've started the value creation process from the sales side, and the data capture, the buyer-seller interaction is the unique data we collect, on which we run machine learning and AI models to provide insights to both sides of the equation. Here's some of our customers, and this is the ROI and impact we deliver. And I was asked to provide some details about the go-to-market. This is a snapshot, obviously. There's a lot more detail around it, but who's our buyer? So our first ICP are large high-tech companies, such as VMware. And the buyer there is the VP of Sales, the VP of Sales Ops, and the VP of Product Marketing, was a pretty strong influencer. And then we have a second ICP that we're targeting, which is in the mid-market high-tech space. And there the buyer generally is the CRO, and the CMO is a very strong influencer. From a user perspective, the sellers, the AE, the sales engineer, the professional services person, and also the partner involved in a B2B buying decision or process is the user. The buyer is, of course, the user, because they get to experience all the information that's being sent, and they can collaborate. The product marketing person is also a user, because often they're providing the digital assets and the content that's needed to drive the sales process. And then from an internal resources perspective, we're seed stage. So we have a CRO who also serves as sort of the chief sort of evangelist and the sales strategy creator. We have a very senior AE who works primarily on bigger accounts. And then we have two AEs that are part-time, and they're working on the mid-market accounts. From a marketing perspective, we just have a small budget of $2.5K per month. From a pricing perspective, our ASP is $600 per user per year. We try to do yearly contracts with monthly billing sometimes. The ICP1 in large high tech, we expect the land to be $25K and expand to $250K. For ICP2, the mid-market ICP, the land is targeted to be $5K and expand to $25K. And anything else that's relevant is we've created a freemium version of the product for sellers in our target accounts. So in a few clicks, they can sign up on their own and start using the product to create these, what we call collab spaces, which is the digital buying experience that they can send to their buyer in a matter of minutes. We're also working on a digital trial to buy experience, which has the full version of the product. So that's pretty much it from a go-to-market perspective for the time being. And I look forward to the conversation.
Cool. Thanks, Arun.
Mm-hmm.
So Shruti, maybe we'll start off with you. So if you were an investor in Contig, how would you be advising Arun to start approaching and start thinking about his go-to-market strategy?
Yeah, I think I would want to know a little bit more information here. You're trying to do like a top-down or bottom-up. I couldn't figure out that. Was it you said 600 per seat, but is it like a contract size based on number of users? Or is it, I think I want to understand a little bit more about your pricing.
Yeah, so right now it's top down. We're still working on our bottoms up flow. And it's generally what we found is that the contract size is based on the number of users. So we tried to do, but because at the land stage, we tried to basically do a pilot for $25K with a big company, or a pilot for between 10 to 50 users in a. So I talk about the two ICPs. For big companies, we say, hey, 100 users, $25K for 3 months, and then we do the big contract. So that's the pilot, and then we do the expansion.
So your freemium offering doesn't match up with something like that, though. If it's top down, are you trying to generate a pipeline there?
Yes, that's exactly the bottoms up. The freemium product, we're still working on that, but that's supposed to drive more demand in the mid-market segment, even in the top segments, basically to get meetings. So when we go to the VP of sales, we already tell them, hey, you've got 50 users or 10 users in your account, and that makes for a better conversation, a better meeting. So we can show some usage and sort of adoption already.
I think
so. We primarily use.
Yeah, I think that is, if your product offering can lend itself into just teams using you without getting any permissions, otherwise for free, that's a good dial for dollars kind of exercise you can do right after that, as you said. So it's the right direction for what you're thinking about, but I'm not sure then if you can then go from there to 600 per user kind of pricing, unless there's something pretty substantial you're offering beyond the current set of offerings, so the freemium offering you have, which may be integration, other things, which I'm not sure if the user cares about. So I would focus a little bit more about that piece of exercise. If you're trying to build a bottom-up user base, see what they would want to actually pay for, and they're dying to us, get a budget approval for that. And then you can do the whole top-down sale. But I think initially right now, I would focus on one or the other. The top-down is going to continue to happen because of your network, right? You're going to keep talking to those people. But if you're going to actually energize the whole company around an initiative, it should be around one or the other strategy. And that's where I would focus more on bottom-up in your case.
Yeah, I think it's a timing issue. So right now we're still kind of designing our bottoms up. So until then, we're using our network and the network of the sellers to, for the more seasoned sellers, we're putting them on elephant hunting. For the for the younger part-time sellers, we're focusing them on mid-market selling. But the long-term strategy is to go bottoms up. So we're expecting that to deliver that product in early Q1, and then we start the bottoms up motion.
Do you feel, Arun, that your ideal customer profiles are well validated? It seems like you're biting off a lot at this stage of the company. I don't know exactly how much have you raised?
We've raised close to $3.5 million to date.
And what sort of process did you go through to create your ideal customer profiles? What did that look like?
Well, so what we did was, the process was, we came up with a hypothesis of where we felt the highest pain was, and we worked very closely with VMware and Deloitte, who were our initial customers. So we were very entrenched into building the solution for them, and we created a solution more for the enterprise early on. But then we decided, then we were noticing that these deals are taking too long, to close and to deploy and so on. So we focused. That's why we created the ICP2, which is more mid-market. So these are smaller companies like Tradeshift and Rubrik who can quickly deploy and get going. So yeah, I would say we're in early stage because the product you're seeing now, the B2B network with the digital buying experience, is a pivot from what we were doing before, which was more centered around like content recommendations and productivity for the salesperson. So we pivoted to this about 3 months ago. And since then, we've had about I would say about in the mid-market and ICP2, we've done about 7 to 8 meetings, and we're seeing good resonance. I think a couple of deals are very close to getting done. So we're constantly evaluating if this is the right segment, but we're seeing some strong signals. We're getting to the next meeting. So we do the initial pitch, the value prop is alignments there. We get to the next meeting with more stakeholders. And now we're in the stage where a lot of customers want to do trials or pilots with us. And that's the stage we're at. So I think it's very early for us to say whether the ICP is validated or not, but expect to have that decision in early Q1.
Because it seems to me that one thing that could be significant that you're probably in the process of uncovering, so it seems like you're doing good work there, but it's how large are the sales teams that are ideal? Because enterprise and and mid-market. Like that can mean a lot of different, there's lots of different sizes of teams across those two buckets. And so I assume you're sort of drilling into
yes,
how much revenue or how many salespeople or how many SDRs versus AEs, or there's probably a lot of thinking that can go around in data collection that can go around turning that up.
We have that. There's a very detailed version of the ICP. So we're targeting companies with at least 50 salespeople and at least 50 million in revenue.
Got it.
And they're ideally selling to other B2B companies, which are either enterprise or they have longer, complex sales motions. The sales motions take at least 3 months or more. The dollar size of what they're selling is at least 100K or more. More complex sales. This tool is not very suitable for widget selling, or like if you have a very, defined product, it's not a very good fit. It's for more complex sales motion for complex products. So another segment we've been exploring is consulting companies, and we're seeing some interesting traction there as well because they're selling very complex services.
Ariana, anything to add?
Yeah, focusing a bit more on the supply side, what types of products are you more so focused on? Like which types of products are these big companies having a lot of trouble sifting through the noise with? And then also, what are the unique data types that are most important for them to be able to sift through that noise? Have you given that a lot of thought?
So on the supply side, can you help me understand when you say supply side?
Yeah, so you have these big high-tech point. What types of products are they most interested in, where there's probably a lot of noise out there? It would take them a lot of time to find the ideal solution. How are you thinking about that supply side for those customers? So which types of products are you prioritizing? Because you can't really boil the ocean at the stage you're at. And then also, what types of data types are you collecting? So it helps them just kind of parse through all of that to get to a decision quicker.
I see. Okay. So so we're focusing right now, we're still building a hypothesis on this, but we're seeing good traction in the SaaS space. So for example, the projects we're doing with VMware, they have a portfolio of about 37 products. Some of them are very mature, but they're also launching some SaaS-based offerings where it's a new product and they want to explain it to their buyers in a unique way. So SaaS products is one big thing that we're noticing. And the other thing is the kind of data we're collecting from a buyer perspective is, so when you send them a digital sort of what we call a collab space, which has many digital assets that they can consume. So we measure open rates, we measure let's say you send them a deck, we measure how much time was spent on each slide. We see how quickly they are to respond to questions. So we also have chat capability built into this experience. So we see how many chat messages have been exchanged. We also integrate with email, so we can see how many emails you got from the buyer, what their sentiment is. So based on all of this, in fact, that's our uniqueness, is we create a predictive score called the buyer engagement score. So we're looking at all the engagement a seller is having with the buyer across multiple channels, could be email, could be across this collab space, could be Zoom meetings and so on. We keep adding more and more engagement data capture channels. And what we present to the seller is a predictive score, which we call the buyer engagement score, which predicts how engaged they are and how likely they're to move to the next stage, sales stage.
Cool. I want to be mindful of time. I think we'll thank Arun for joining us and being the subject of everything. So Arun, if you want to step down, and Mary, if you're in the audience, if you could join us and join us on the stage. So we're going to do this one more time. Hey Mary, thanks for joining. Go ahead and share your screen.
Hi, Mary.
Share your slides. And so we'll do this one more case study. Again, if you're in the audience, thank you for the questions. For the ones outside of the case studies, I'm going to leave time for at the end, and so we'll try to get to everyone's questions. If you have anything around the case study that we're doing, you can feel free to add that. Looks like Mary, we're seeing your screen now. Ariana, we lost your video. If you want to come back and. All right. Cool. Mary, I'll let you do it.
Great. Well, thanks for having me, and thank you for being here. I love listening to your questions for everyone, so hopefully yours will be as difficult for me. So I'm the CEO and co-founder of Marlowe, and we are really tackling a problem that's been around for a long time, but the marketplace has shifted and made it more pressing than ever. So coaching has long been the most effective way to develop executives and really leaders and emerging leaders of all types. But traditionally, it's been much too expensive to roll out to anybody outside of the C-suite. And then adding to that problem, it's a really fragmented space, so it's difficult for to find great high quality coaches because they're all trained in their own methods, plenty of training programs out there. It's just not a lot of consistency. And so what we did was take the best parts of executive coaching and redesign it to be the most effective resource available for managers and emerging leaders. We also coach directors, but we do this by hiring our coaches in-house and we retrain them in our systems and processes. So they're already coaches, but they get another level up of training. And then we provide them with systems and tech support to be much more efficient and effective. Sorry, I'm kind of not keeping up with these slides here. So hiring and retraining and then augmenting them on the back end. So what this does is traditional coaches are working with 11 to 15 clients. And this really includes even those big marketplaces of coaches that you've heard of that are doing so well and really expanding the market. But really they're still only coaching a few people at a time. And so we wanted to expand that in order to reduce the cost to the end user and increase our margins. So Marlowe coaches can coach 65 members today, but we're getting that up to 100 clients, hopefully by the end of next year, using technology and just more efficient systems. And that gives us 70% margins. So our whole approach, I could give you a million different other features and reasons why companies love us, but we're personalized to the company and to the member. And so we've really shoved that one-size-fits-all training solution out of the way to make space for something that's much more high impact, and then it's really flexible. And so I'm gonna just kind of jump through to the go-to-market, but before I jump into it, I wanted to talk about why coaching, why now, and why Marlowe, because I think it gives some color to who our target buyer is and why we've gone after them. Today in particular with the pandemic, companies are seeing this huge opportunity to expand globally. If not globally, at least within the US, really expand that talent market. And so that's a huge opportunity to have a great workforce that's maybe a little more affordable, more flexible, and widens a lot of opportunities, but it also creates a challenge for training. So what worked in an in-office setting, where a manager can walk by a coworker and have that serendipitous training opportunity, it just doesn't happen in a remote environment or a distributed environment. And so the timing has never been more important. And then on top of that, CEOs and leaders have already for the past year or two been talking about how important it is to reskill and upskill their workforce. But most solutions are very one size fits all, like I mentioned before. And so what we're seeing is this shift toward wanting something that is personalized, and then employees are demanding it. They want learning opportunities, they want resources to be successful, and they don't want those resources to suck. And like a lot of times they do, they're just not very good. And so that's where we've focused our attention, and I think there's a huge opportunity to adjust our go-to-market, so hopefully you have some ideas there for us as well. So who's our buyer? We started with companies that were largely mid-market for the most part, but we've really worked with SMBs to enterprise level. We've worked with Chrysler, we worked with Panera Bread, and what we found is that mid-market is really our sweet spot. So anywhere from 200 employees, that's more on the SMB side, to about 5,000 employees. Distributed teams have always been our bread and butter. We've loved working with companies that are trying to manage teams across multiple time zones, multiple locations, and often that creates a lot of unique challenges that coaching is really perfect for. And then companies going through internal transitions, which today means the whole world, which has been really interesting for us. But internal transitions can be anything from hyper growth within a department to a CEO just got suddenly fired and now you have to figure out what to do. And this has happened with previous clients. And so just going through that process creates a lot of challenge where coaching is perfect. Target decision makers, well, so when I mentioned this opportunity, all these CEOs are looking at their HR leaders and saying, hey, we know we undervalue you and under-resource you, but if you could solve this problem for us so we don't have to think about it, that would be great. And it is a front of mind thing. So we're definitely going after HR, but we're also going after learning and development because they see a lot of opportunity to expand what they're doing. they don't see us as a threat. They actually see us as a huge opportunity to coach more of their team members. And they love that we're external and objective. So nobody has to worry that that conversation will come back to their manager and get them in trouble. We also see opportunities with department leaders. So sales, engineering.
Sorry, Mary, I just want to be a little bit conscious of the time. Do you want to just get through the last little bits? Cool.
Sure.
Thank you. Sorry.
Yeah, of course. So who's a target user? Manager's department. I'll just flip through this, but I'll go to ACV and price. All right, so 40% of our budget's going to sales. 2 salespeople, 2 co-founders supporting it, but those salespeople are really focused on inside sales, LinkedIn, email, etc. Revenue model is subscription, anywhere from 1 to 12 months, typically with our companies. Prices range from $275 to $225 on the 12-month program. And our members per deal, you have all the math there. I'll leave that up while we're chatting through it. But ACV tends to be 20 to 30K, but LTV is upward of 75 to 100K. We're hoping that will continue to grow. So.
Thanks, Mary. Pete, we'll start with this time. So again, if you were an investor in Marlowe and working with Mary, how would you advise thinking through the go-to-market?
I guess just one quick question. I'm curious if you see this as a two-sided marketplace.
Interesting. A year ago, I would have told you we're definitely not a marketplace. I think we're a very closed marketplace, but our coaches work full-time for us. We're recruiting them in-house. Mm-hmm. Huge, to get to 100 million in an ARR, we really need about 100 coaches. So just to put that, 300 coaches, to put that into perspective, right? So
let's assume that you don't have a supply side problem on your coaches, which with enough success you will run into, right? But let's say that that's not the problem right now, and we want to focus on the demand side of the marketplace. To what extent have you figured out how to tap into these budgets that are earmarked for this sort of thing at larger companies? I don't know the space, but I'm sure you've looked into that.
Yeah, I mentioned the big coaching marketplaces that have kind of come out. They're 5 years older than us. There's a lot more awareness around coaching, so that's helpful, right? Already we're seeing the market expand. Coaching is more in demand. Employees, same thing. So they're asking for it. So that has helped. Where we're still running into obstacles is like, how do you help a team shift away from these outdated solutions like really long workshops or trainings and toward something that's a little bit more personalized. So it's not so much a problem of carving it out of their company budget as it is helping L&D and HR carve it out of their internal budget. And so right now it's a lot of education. I think that's where our biggest opportunity lies. And then the bigger the company, the more likely they already had space for this because they were offering executive coaching before and they understand how much cheaper we are. So they're seeing this as a huge opportunity to expand that service.
Well, I really like this idea that you can sort of democratize coaching below just the executive and the C-suite level. I think obviously that's where you want to be. The one thing about the differentiation and sort of your specialty that didn't sit quite as well with me is I get that companies and people need help during transition times. It's the same reason an individual goes and finds a therapist when they're getting a divorce. The problem with that is it doesn't smack to me of like lending necessarily to a repeatable sales process because it's a little bit difficult. That's a very time-based thing, and you sort of have to find that window of opportunity when the company needs you most. And so that was just one general insight I had is it's nice that you thrive in those situations, but to bring potentially more repeatability to the process, that's one variable that might be nice to work out if possible.
Right, thank you. Yeah, and just for clarification, it's a separate, so we go for distributed and then separately those transitions, but the distribution is more our bread and butter for sure. So thank you for that.
Mm-hmm. Go ahead, Ari.
How would you prioritize your customer type based on their existing solution? Would you first target folks that already have executive coaches in place, or have these training programs, or maybe no solution at all? Like, how are you thinking through the prioritization of your customer type?
Yeah, it's definitely easier to come in when they already know the value of coaching. So those companies with great coaching mentalities, even if it's just growth mindset, or a lot of times they've rolled out a mentorship program internally and they realized how time consuming it was. And so now they're exploring external coaching. So that's a good opportunity for us at our stage. We're a pre-seed stage company. As we grow, I think that's where you have more opportunities to change hearts and minds. But yeah, it's definitely easier to get somebody who's already bought in.
Gotcha. And what subsect of the market falls into that category? And then how do you plan to kind of bridge the gap and communicate the value to a broader market that doesn't have a solution in place?
Yeah, it tends to be companies that truly value employee engagement, employee development, like they care a lot about employees. And so we target based on those companies that are advertising how much they care about their employees. They have extra benefits, they're promoting out, they promote from within. And so sometimes that can be a little tough to find, but there are a lot of resources we've been using. So how can you, identify those first? And then starting to expand that to just looking at Indeed and Glassdoor and like all these different ratings of how much employees feel like they were valued within their companies, and then expanding from there. We do find a lot of opportunity within traditional industry, so manufacturing in particular, where they're promoting from within. And so, again, they brand themselves that way.
Gotcha. And then final question, do you see this having an ROI for these companies? Or is this more so checking a box that we're providing wellness services to our employees? What message is really landing with your customers?
Yeah, well, there's two things. One is our customers and one is just where we want to be, period. So we won't be in this space. ROI is so important because you cannot keep getting budgets for these programs unless you can prove that there's some return on that investment. And so traditionally, learning and development has really stopped it. Does that program exist? Do people participate? Do they like it enough? We're carrying that through to, are they changing their habits? Are they improving their performance? Does that impact the bottom line? Those further pieces are tougher to measure from where we are, and we're looking into how we can change to do that. But we're at least surveying team members and their managers to say, what kind of impact is this having? Are you seeing measurable results? Do you see that, performance tick upward? It's essential, and they care. We're educating a lot on that space too, because they just haven't traditionally known how to do it well, because it's time consuming for them and, an extra thing for a small team to have to worry about.
Very thoughtful. Thank you.
Thank you.
Shruti, anything to add?
I would just add that on your go-to-market for the cheap side, I would add channel partners. There are a lot of companies coming up today that are aggregating benefits for different types of things for companies. And I would use them as channel partners to get into to customers of yours. And I think what you need to figure out is one thing: what is success? I think you're trying to cover a lot, but I think what is success for your customer? Why would they keep, if it's a one-time engagement per year, is that enough? Or if it's once a month, I think you just need to figure out what that is and just hone in on that.
Mm-hmm. Thank you. And we've seen the most opportunity with expanding our accounts. So it's been really fun to see how much they stick around, but there's a lot of opportunity there. And then I would love to get your thoughts at a future date, maybe on distribution partners, because we're starting those small experiments, but we have a lot of room to tackle more.
Actually, it might be a good one to just think through a little bit now. Shruti, how would you recommend, Mary, think through in terms of, resources are constrained, of course, doing direct sales versus, trying to look for channel and partner sales?
Channel and partner, you only need a couple anyway. So if you want to get those going, do a rev share with them. And then direct, just don't stop. That's your bread and butter. So channel is just to amplify that a little bit more. But I think all this is easier said and done when you can just say one thing, which is, this is my value prop, because there are a lot of companies out there doing this. And I don't really tend to invest in this market, so I don't tend to understand fully the differentiation side of things here. But I want to know more about, what does a customer think is valuable? For a Calm and Headspace and those kinds of categories of solution, I've heard things like, if a employee logs in once a month, that's considered engagement for them. So for you, I don't understand it. I don't know why are they buying more? You need to call your customers today and say, why did you buy more?
We have a lot of that data.
So you just need to focus on one of those things, not everything. Your KPIs on success is not 5 things, just one thing of why the customer buys you and why you can upsell to them. And because then you will hone in on better coaches or more curriculum, or I don't know what that is, right? that's the piece I'm not able to figure out, like what to tell you exactly on to focus on, because you're doing a lot.
Could I add one more point? There's also various consulting firms that focus on culture and obviously employee wellness. So that could be an effective channel partner too, as you're exploring that some more.
Thank you. Yeah. We've seen some hints there. We're talking with a couple companies.
Awesome.
It's the biggest challenge. We're a team of 7 people, right? And so a big challenge for us is how do we strike that balance of prioritization? I was actually just talking to Jason pretty recently, and he said, spend 10% of your time on distribution channels. And I think that's the right way to think about it. How can we start to have those conversations and continue to hone in on the other, like you said, the other core value props? Huge opportunities there. More than we could fit into a 1-minute pitch, but there's a lot of
absolutely
a lot of focus happening.
You did great, Mary. Thank you again for being the one that we all get to poke holes and ask questions. So thank you. I appreciate that.
Thank you so much for all your thoughts.
Of course. So we have a few additional questions from the audience. So we'll just try to run through those in the last few minutes. So Tim was asking about how deals are typically being structured in terms of rounds. So convertible debt versus preferred shares. So safe notes or price rounds. So Shruti is kind of the largest check writer of the group. Do you have a preference on that? What do you think is standard in end of 2020?
Standard is up in the air right now. It's all over the map. It's whatever your investor and you want to settle on. But jokes aside, I think founders think it's best for them to just do a safe note and just add capital and move on. But you know what? That comes with a price, which is if you're doing fine, that's fine. But if you're not doing fine, all those safe note investors disappear because they have essentially no shares even at that point. So I think you have to figure out what you're trying to optimize on. Some people say it's speed, and some people say it's different types of caps for the safe, depending on your safe instrument. We've definitely invested in safe rounds, don't get me wrong, but you also suffer the consequences of that on the other side once the money's in on a proper round versus a safe round where people don't feel like they're not a lead owner of that round, right? Like there's no fiduciary responsibility in some ways at the board level or something like that. So I think it depends. Some people do structure, 1 or 2 investors in a safe round for the matter of whatever situation they're in. But ideally, we like to not do safe rounds per se anymore. If we do those as a fund, I know that my commitment in those companies is going to be more of an observer and not a more hands-on investor. So we have to be all aligned, and that's what we're optimizing on. And I think that's fine. Again, a senior experienced operator founder sometimes, just needs a good network and not a lot of investors that can be more hands-on, and that's fine. So the instrument has to match with what you're optimizing for, and the investors will come along accordingly for that for you.
Great. Peter, Ariana, if you have anything to add, feel free. Otherwise, go to the next one.
Sure.
Nothing to add there.
I guess quick add for me, most of what I'm doing is or convertible notes and safe notes. And I've been advising companies I work with, because I tend to come in and meet the founder right before they're even considering fundraising, is not to look for a lead investor specifically in the pre-seed stage, because you want to just keep that momentum going and have more of a rolling close and get to a close quicker, because you can lose that momentum. Because there typically aren't a lot of lead investors at the pre-seed seed stages. So lock that in and let's keep going.
I just want to add, we're a pre-seed stage investor, but we do.
Yes. So hit up Shruti. Yeah. There you go.
Putting it out there, and we do not lose momentum. We're closing 2 deals right now. One of them is closing in less than a week. The other one's closing a little bit longer, but it's not us. It's the team. So they're doing. Yeah. But I agree with you, Ariana. Momentum is important. That's another reason to consider how you structure your rounds. But that should not come at a cost of how you operate and work with your investors down the road.
Great.
I'll have
Next
to
question
mediate
comes-
between the two of you because I'm investing in both.
The next question comes from Rick. He was talking really specifically about cybersecurity and upper mid-market, but I'm going to generalize the question a little bit. So how do you feel about kind of the self-serve, letting your users, letting your customers sign up, get going on an account versus the kind of the roadblock where, schedule a meeting, got a call, before you have to do the demo before getting in. How do you think about balancing that? Maybe Pete, if you have thoughts around that.
Yeah, overall, I mean, I think most people, it seems like in venture, agree these days that, of course, there's a place for top-down sales, and sometimes, especially as founder-led sales, that's sort of all you can do. But overall, I like seeing companies that have some bottoms-up approach. In my world, that comes through open source projects, that comes from community sort of enhanced things, that comes from try before you buy. So I understand there's challenges there, but especially also considering the pandemic and the time that we're in now, I think many savvy investors are concerned about purely top-down approaches because they just don't scale as well, except in the largest examples. I think of Twilio, who was basically all bottoms up. Those big billboards on 101, ask your developer, right? The only thing that mattered to Twilio is what your developer thought. And then later, after years of success in honing that machine, that bottoms up machine from the grassroots side, then they started to add sort of direct sales on top of that and really blew out the business. But those are the stories that I like to see. So I know that bottoms up is hard, and I know that freemium is hard. But I think that a company that isn't taking a big swing at figuring that out is going to be left behind in other ways.
For early stage companies, I think you're missing out on a really great opportunity to spend time with your customer and get as much insight as possible. So I'd warn against having too much self-service too early on. But I think that's more generalized for pre-seed companies. Obviously you do want to transition to something automated and scalable, but if you can have more customer face time, that would serve you better, I would imagine.
I think it depends on the company. I don't have a canned answer for this right now, but it depends on what you're trying to go for, and I'm a pro for both right now. So yeah.
Cool. We've got one last question here from Donald. So if there's a company that's kind of going into the round, has some revenue, but I guess the revenue is more coming down the pipeline. How do you best recommend to message that to investors so that you're seeing like you're keeping things on the straight and narrow? Thoughts on that one? Maybe Ariana, you want to start with that one?
Yeah, I think I understand the question, and if my answer is way off base, just let me know. I think you should show as many positive signals as you can. So try to get signed LOIs, try to show how robust your pipeline is, try to show how thoughtful your strategy is to closing these customers quickly, and whatever data you can present. I think that would tell the story best, specifically if you are pre-revenue, and also articulating if you have multiple types of revenue streams, how are you going to prioritize that, and any data you have there, even customer discovery insights. I love seeing notes from customer discovery calls as part of my due diligence process. So that's always fun, and digging into the pipeline and understanding case by case where all those conversations are. So if you can articulate a great story around those points, I think it's a winner.
I think this discussion also tends to show how competent the founders are, especially in an early company at direct sales, because if you have your act together, if you have pipelines, if you have sort of showed qualification process, especially in the open source world right now, believe it or not, we're starting to see that many companies are raising A, based on open source traction, and B, based on sort of the promise of a little revenue. And so you put those two things together and you get sort of this unique, maybe we're at a unique space and point in time where that works. But sometimes I see these two models go together, and it's interesting how investors respond to the potential of revenue in those situations.
I would just add one thing to what Ariana and Pete said. I think if I understand the question, it could also be the way you're communicating it. It's booked versus committed. So I didn't fully get a sense of what you're talking about, but there's definitely a way to talk about it from the perspective of, revenue coming in today, tomorrow, year from now, aggregate, and what the customer total is worth as well. So just another side of how you communicate all that. But yeah.
Awesome. Well, we are out of time, a couple minutes over. So thank you to everyone who asked questions. And sorry if I didn't get to everyone's questions. Pete, Ariana, Shruti, thank you so much for joining us and for the awesome advice to Mary and Arun. Thanks to them if they're here. So what's coming up next is we're doing partner office hours at 12 o'clock. So for those of you who have signed up for that, we'll see you then. And then for everyone else, thanks again for joining, and have a good lunch. And then at 1 o'clock, we've got a conversation about scaling go-to-market, and that's happening on one of our main stages. So thanks again, everyone.
Thank you.
Thanks, everyone. Ciao. Bye.
Bye.